On March 28, 2023, Saudi Arabia's finance minister, Mohammed al-Jadaan, made a statement that should have dominated headlines worldwide, but was buried on page 17 of most newspapers. There are no issues with discussing how we settle our trade arrangements, whether it is in the US dollar, whether it is the euro, whether it is the Saudi riyal. Translation: after 50 years of pricing oil exclusively in dollars, Saudi Arabia, the linchpin of the entire petrodollar system, just announced they're open to alternatives, and within 8 months they formalized a currency swap agreement with China worth 50 billion yuan, while joining a cross-border payment system designed specifically to bypass the dollar. If you want to understand why the petrodollar system that's anchored American financial dominance since the 1970s is unraveling right now, not through dramatic collapse but through quiet infrastructure building that makes dollar exclusivity obsolete, subscribe to the Econaut. We track the structural shifts in global finance that most analysis completely misses until it's already too late. Here's what makes this moment different from every previous death of the dollar prediction you've heard. Saudi Arabia isn't publicly renouncing the petrodollar, they're not joining an anti-American coalition, and they're certainly not burning bridges with Washington. They're doing something far more strategic. They're building optionality, creating parallel systems that reduce dollar dependency without requiring them to choose sides. And that measured approach is precisely what makes this transition irreversible rather than rhetorical. The petrodollar system as we know it originated from intense diplomacy between the Nixon administration and Saudi Arabia during the 1973-1974 oil crisis, though the actual history is more complex than the simplified story suggests. On June 8, 1974, Secretary of State Henry Kissinger and Saudi Prince Fahd signed an agreement that's been mythologized as the formal Petrodollar Pact. But when you read the actual document declassified in 2016, it focused primarily on the Joint Commission on Economic Cooperation, technology transfer, infrastructure development, bureaucratic modernization. The dollar exclusivity for oil sales emerged organically because the dollar was already the dominant international currency. US Treasury bonds offered the most liquid market for recycling oil revenues, and Washington provided an implicit security guarantee that protected Saudi Arabia's oil fields and regional influence. By 1975, all OPEC members were pricing oil in dollars, creating what economist Ibrahim Owais termed the petrodollar system, a framework where oil-producing nations accumulated massive dollar surpluses, which they recycled into US financial assets, creating structural demand for dollars and treasury bonds. This allowed America to run persistent trade deficits without currency collapse. This arrangement delivered extraordinary benefits to the United States. Automatic global demand for dollars regardless of fiscal policy, the ability to borrow trillions at artificially low interest rates as foreigners needed dollars for oil purchases, an economic leverage over any nation that required oil, since cutting them off from dollars meant cutting them off from energy. For 50 years, this system remained essentially unchallenged despite occasional threats from Iraq, Libya, and Venezuela to price oil in alternative currencies. But none possessed sufficient market power to create a viable alternative, and several of these attempts ended with regime change, suggesting Washington's willingness to defend the petrodollar with more than economic tools. But three developments converged between 2018 and 2024 that fundamentally altered the equation. China became the world's largest oil importer, surpassing the United States. America's weaponization of the dollar through sanctions against Russia, Iran, and Venezuela demonstrated that dollar reserves could be frozen through executive order. And China built actual financial infrastructure capable of processing non-dollar oil transactions at scale. On March 26, 2018, China launched yuan-denominated crude oil futures contracts on the Shanghai International Energy Exchange, inviting foreign participants for the first time to price and trade oil in a currency other than dollars, with full convertibility and physical delivery mechanisms. Initial skepticism suggested this would fail like previous attempts with the Petro-Rupee or Petro-Ruble. But by January 2019, daily trading volume on the Shanghai Exchange averaged 248 million barrels equivalent, roughly 20% of global crude futures activity. This demonstrated genuine market acceptance rather than forced adoption. According to Bloomberg Intelligence, the Shanghai Oil futures contract now accounts for 10 to 20% of global crude futures turnover as of 2024, ranking 6th globally in trading volume among major oil benchmarks. And while this remains concentrated in shorter dated contracts, it represents functional infrastructure for pricing oil outside the dollar system. The petro-yuan offers specific advantages for sanctioned nations. Russia, Iran, and Venezuela can sell oil to China and receive yuan that converts through Shanghai Gold Exchange mechanisms or settles via China's cross-border interbank payment system, without touching dollar-denominated infrastructure where US Treasury can impose freezes. But the breakthrough moment came when Saudi Arabia, America's most critical petrodollar partner, began exploring these alternatives. Not from hostility toward Washington, but from rational economic calculation about where their largest customer base actually exists. China surpassed the United States as Saudi Arabia's top trading partner in 2011. And by 2023, Saudi Arabia exported approximately $63 billion worth of oil to China annually, representing roughly 25% of total Saudi oil exports flowing to a single customer that prefers paying in yuan. In December 2022, Chinese President Xi Jinping visited Riyadh and explicitly encouraged Gulf Cooperation Council countries to make full use of the Shanghai Petroleum and Natural Gas Exchange as a platform to carry out yuan settlement of oil and gas trade. While Western media dismissed this as symbolic posturing, Saudi Arabia quietly began operationalizing the infrastructure. November 2023, Saudi Arabia and China signed a 3-year currency swap agreement worth 50 billion yuan, approximately $7 billion, enabling direct yuan-rial exchange without dollar intermediation. June 2024, Saudi Arabia's central bank joined the mBridge project as a full participant, a multi-central bank digital currency platform developed by the Bank for International Settlements alongside China, Hong Kong, Thailand, and UAE, specifically designed for instant cross-border payments bypassing traditional dollar clearing mechanisms. The mBridge platform reached minimum viable product stage in June 2024, meaning it's now operational for real commercial transactions. And Saudi Arabia's participation signals intent to utilize yuan-based settlement for at least a portion of oil sales to China through faster, cheaper channels than correspondent banking through New York. September 2024. Saudi Arabia's Minister of Industry confirmed the kingdom is open to new ideas regarding yuan settlement for crude oil, stating explicitly that Saudi Arabia doesn't view currency choice as a political decision, but rather as commercial optimization. Now here's the critical nuance that most analysis misses. Saudi Arabia hasn't abandoned the petrodollar, they haven't joined an anti-American bloc, and they're not pricing all oil in yuan. Saudi Arabia was invited to join the BRICS Economic Alliance in August 2023 alongside UAE, Egypt, Iran, and Ethiopia. But unlike the others who confirmed membership by January 2024, Saudi Arabia neither accepted nor declined. They've remained deliberately ambiguous, attending BRICS summits as observers while avoiding formal commitment. This isn't indecision, it's sophisticated hedging, where Saudi Arabia maintains access to both dollar-based and yuan-based systems simultaneously, preserves security relationships with Washington while deepening economic ties with Beijing, and avoids forcing a binary choice that limits future flexibility. The Saudi Riyal remains pegged to the US dollar at 3.75 riyals per dollar, meaning any significant dollar devaluation directly harms Saudi Arabia's currency, which creates structural incentive to avoid deliberately damaging dollar dominance even while building yuan alternatives. What Saudi Arabia is executing isn't dollar abandonment, but optionality creation. The ability to price oil in dollars for Western customers, yuan for Chinese customers, euros for European buyers, and potentially a future BRICS common currency for specific transactions, extracting maximum value from each relationship without exclusive commitment to any. But here's why this measured approach actually threatens the petrodollar more than dramatic renunciation would. It normalizes the idea that oil doesn't require dollar settlement. It builds working infrastructure for non-dollar energy transactions. And it demonstrates that America's most important Middle Eastern ally views dollar exclusivity as negotiable rather than permanent. The data shows this transition accelerating measurably rather than remaining theoretical speculation. The dollar's share of global foreign exchange reserves declined from 72% in 2000 to approximately 60% by 2024. A 12 percentage point drop representing trillions in diversification. And importantly, this decline has accelerated in recent years rather than stabilizing. The yuan's share of global payments grew from essentially zero in 2010 to between 3.75 and 5% by December 2024, according to SWIFT data. And while this remains far below the dollar's dominance, the trajectory shows consistent expansion, particularly in commodities trade. Russia now settles approximately 90% of China trade in yuan and rubles after being cut from dollar systems following Ukraine invasion, proving that major economies can function outside dollar infrastructure when motivated by sanctions risk or strategic calculation. India began purchasing Russian oil in rupees and UAE oil in Indian currency, following bilateral agreements in 2023, demonstrating that even US allies are diversifying currency usage for energy transactions when economically advantageous. The Shanghai International Energy Exchange processed approximately $27 trillion in crude oil futures transactions during 2023, more than double the $12 trillion processed in 2020, indicating genuine market depth developing for yuan-denominated energy contracts beyond just Chinese state-directed activity. But the most significant threat to petrodollar dominance isn't yuan replacement, it's fragmentation, where oil gets priced in multiple currencies depending on buyer-seller preferences. And that fragmentation destroys the automatic global demand for dollars that's sustained America's ability to run unlimited deficits. If 20% of global oil trade settles in yuan, another 15% in euros, 10% in a future BRICS common currency, and only 55% remains in dollars, the US loses the exorbitant privilege of printing the global oil settlement currency, even though dollars remain plurality. That loss matters profoundly because it reduces foreign demand for US Treasury bonds. If Saudi Arabia receives yuan from China, they invest those proceeds in Chinese bonds or Shanghai gold, rather than recycling them into New York financial markets, tightening the dollar liquidity that's financed American fiscal expansion. Current US federal debt stands at $38 trillion, with the Congressional Budget Office projecting persistent trillion-dollar deficits indefinitely. And that debt load remains serviceable, partly because foreigners need to buy treasuries to acquire dollars for oil. Remove that structural demand and interest rates rise to attract buyers through returns rather than currency necessity. The petrodollar system allowed the United States to export inflation by printing dollars that foreigners willingly held for oil purchases. But as that system fragments, excess dollar creation stays domestic or requires higher yields to attract foreign capital. Constraining fiscal flexibility, Washington has enjoyed for 50 years. Saudi Arabia's strategic ambiguity accelerates this process, because it signals to other oil producers that dollar exclusivity is optional rather than required. And once the psychological anchor breaks, once markets accept that major oil exporters will transact in multiple currencies, the petrodollar becomes just one option among several rather than the mandatory global standard. The parallel here isn't dollar collapse, it's sterling decline. The British pound didn't disappear when it lost reserve currency status after World War II. Well, it remained significant but no longer dominant, no longer granting Britain the extraordinary privilege of importing more than it exported, while other nations willingly held its currency. America is following a similar trajectory, where the dollar remains important but not hegemonic, used for perhaps 50 to 60% of global trade rather than 80%. And that 20 percentage point difference translates to dramatically reduced ability to run deficits without consequence. China doesn't need the yuan to overtake the dollar to achieve strategic objectives. It needs the yuan to become sufficiently viable that countries have genuine alternatives when dollar access becomes weaponized through sanctions, or when economic self-interest suggests local currency settlement. Saudi Arabia's mBridge participation, yuan swap agreements, and openness to non-dollar pricing accomplishes exactly that. It makes yuan-based oil transactions normal rather than exceptional, reduces the cost of future sanctions evasion for countries that fear dollar freeze risk, and demonstrates that even America's closest Middle Eastern partners view diversification as prudent rather than disloyal. The timeline for this transition appears to be measured in decades rather than years, meaning the petrodollar won't collapse overnight but will erode steadily as infrastructure matures, transaction costs decline, and psychological barriers to non-dollar settlement dissolve. By 2030, credible projections suggest yuan-denominated oil trade could reach 25 to 30% of global volume if current growth trajectories continue, with dollars falling to perhaps 65% from current 80%. And that shift alone would reduce foreign treasury demand by hundreds of billions annually. By 2040, a truly multipolar energy currency system could emerge, where dollars, yuan, euros, and potentially a BRICS common currency each capture meaningful market share. And the United States would face the same constraints other nations experience: fiscal discipline required to attract voluntary treasury purchases rather than automatic demand from petrodollar recycling. The tragic irony is that America's own sanctions policy accelerated this transition by demonstrating that dollar reserves aren't safe from political seizure, that SWIFT access can be revoked through executive order, and that financial infrastructure dependency creates vulnerability rather than security. When the US froze $300 billion in Russian central bank reserves in February 2022, every finance minister globally calculated, if they can freeze Russia's dollars, they can freeze ours. And that calculation drives infrastructure diversification regardless of current political alignment with Washington. Saudi Arabia isn't ending the petrodollar through dramatic announcement or hostile action. They're building alternatives that make dollar exclusivity unnecessary. And that quiet infrastructure construction is precisely what makes the transition irreversible rather than reversible through diplomatic pressure. The petrodollar system gave America 50 years of exorbitant privilege, where printing dollars created global demand rather than inflation, where massive debts attracted willing foreign buyers through currency necessity rather than competitive yields, and where economic leverage extended through every nation that needed energy. That system is ending not with revolution, but with evolution, not through confrontation, but through optionality. And the country that positioned itself as the indispensable node in global energy finance is discovering that when you weaponize indispensability, others build alternatives. If this analysis clarified why Saudi Arabia's quiet infrastructure building matters more than dramatic pronouncements, and why the petrodollar's erosion happens through optionality rather than replacement, subscribe to the Econaut. Because understanding these structural transitions before they become obvious is what separates capital preservation from capital erosion. The petrodollar didn't die on a specific date with a formal announcement. It's dying gradually as the infrastructure that made it necessary gets replaced by infrastructure that makes it optional. And Saudi Arabia just became the first major oil exporter to publicly acknowledge that transition while building the systems that make it real.